Hello and welcome to this episode of The Capitalist Investor. As always, you have me, Diamond Hands D, and back and better than ever, Luke Lloyd.
Definitely not better than ever. That's for sure.
Cool Hand Luke and Tony the Tiger. What's up, guys?
Not much, man. Hey, dude, Luke, I saw some of the pictures of your fiance's bachelorette party, and they were running around these little fat heads of your face. And I'm still waiting for mine. I want my Luke Lloyd face on a stick.
I don't think anybody wants that.
I do, because it will be used at some opportune time to just. It would be special. Do you think it'd be a good thing?
Not at all.
No, but I still want one.
But what I will say is they are, it's all supply and demand, so you get to pay up for it.
That's
most
fine.
of them have been destroyed.
You'll pay for it later.
Most of them have been destroyed because there were like 20 of them, and they're on Put in Bay. What do you think happened to them? They lost them. They got thrown in the mud. Probably some random person walking down the street, saw my face and was like, "Who the hell is that person?"
Is that guy from Fox?
My mom asked that question if they got anybody to say that. No one got to say that. I'm not Mark Tepper.
All right. Today's financial planning corner: taking unnecessary risk. Some of us do this when we don't know what we don't know, or we just like risk, or we just don't. Maybe you don't know you're taking unnecessary risk. So what that means is that I've actually seen it just this last week. Somebody, I was meeting with a potential new client, and they had about 20% of Nvidia. Nvidia stock took up 20% of their portfolio that another advisor was managing. And I just started asking simple questions. How do you feel about that? What do you think? And he goes, "Well, I left it on the advisor to make the decision." And I'm like, "Well, then what does your advisor say?" And the advisor said, "Let it ride." And I'm like, "How do you feel about that?" And they're like, "Well, I don't, it's not my lane, but I do feel like it is kind of heavy." And I'm like, "Have you expressed that?" And he goes, "No, not really. I just let them do what they want to do." And I'm like, "Well, that could be a problem, because at the end of the day, it's your money." And he goes, "Well, like one of the arguments from the advisor was that, like, well, if we sell it, you're going to owe taxes." And I said, "Well, my take on that is if you are paying taxes, you were successful. If you weren't successful and you lost money, you wouldn't be paying taxes. So, unfortunately, paying taxes is a penalty of success." Is one thing. So we have to understand when you've won the game. And it's kind of like the Browns, up 2 touchdowns with 2 minutes to go, do they, you see a lot of teams do this. They grind it into conservatism, and, so there is a point of being too conservative. Like, you don't get rid of all your Nvidia stock. Like, you take the profits, take whatever you invested in and put it on the sidelines and run with quote unquote house money.
Or write options on it. Not only too far deep into that, or write cover calls.
Sure.
Right? So where you're hedging against the downside, things like that. It's like interesting too when it comes to risk, because really our job at the end of the day is to manage risk. I mean, everyone thinks it's to make the most amount of money or to save the most amount of money. It's like to manage lifestyle risk and market risk in a lot of ways is really what our job is. And when you're managing a 65-year-old retiree's money, it's different than trying helping a 25-year-old, 30-year-old. And what's interesting is the only way to make a lot of money quickly, at least, is to take on excessive amounts of risk. The only way to preserve capital and preserve money is to take on less amount of risk. So it's like understanding that balance of where you're at with your income, with your expenses, with the assets that you have, and your retirement goals and objectives. You have to balance all of those. And when you're young, I'm just speaking to like the 20 to 30-year-olds, like it's okay to take excessive risk because it doesn't pay off. Like you have time to make that back, as long as it's not completely destructive to your situation. When you're 65 years old, you don't have the time to lose 20% of your portfolio because Nvidia crashes because it's up too high. I'm not saying that's going to happen, but like it is time to start rethinking about risk, and it's not always about hitting home runs. It's about hitting singles and doubles when you're at that age of retirement.
Yeah, absolutely. And it's always a giant pet peeve of mine, the thing with the taxes. There's many things to consider there. One of which is that capital gains taxes might go up in the future. So if it's, if you're selling now or later, someone is eventually going to have to pay those taxes, unless you pass those stocks down and they get a step up in basis. And that's another tax rule that is always in the crosshairs. So it is always much better to continue to manage the risk, continue to manage your portfolio, versus, just not trading on certain things that have gains. You really have to have a game plan and a strategy for that, going into it. And, not making moves just because you don't want to pay taxes is something that I'm definitely against. You have to have the balance of your portfolio is way more important than, not paying a tax bill on a big gainer, on a winner.
Yeah. Going a couple of layers deep, then it was like, well, because the person I was talking to, like, again, not as lame, the finance, he's like, well, can't I sell something and like offset? I'm like, yeah, that's called tax loss harvesting is the technical term, but yeah, you sell a loser, you sell a winner, and your net sum is zero tax.
Yep.
But when we talk to people for the first time, what we try to do is show them, hey, actually taking on lower risk upon retirement, whether it's 2 months or 2 years or 10 years before, if your plan is successful and we can show like, hey, toning down the risk is going to make you even more successful. Like, it's not about hitting home runs when you when you can win the game.
Or you could even, another strategy you can implement is sell Nvidia and buy like the SMH or whatever it's called, like the semiconductor ETF that has all the semiconductors. So that way you're not specific to one company. You're diversifying across. I mean, I'm just throwing these out there, like covered calls, swapping it for an ETF. Like, there's different ways to diversify than, like you said, just even going all cash to sell the position. Yeah, it might be the step one, and then you can decide what to do after that. Maybe it's still getting exposure, just in different ways.
Yeah, in one of our actively managed portfolios, I explained this, is that we do own Nvidia in, our growth strategy, and we've tried. They've trimmed it 3 or 4 or 5 different times to keep it at an appropriate amount of risk, the appropriate amount of allocation, because they're one bad earnings call away from going down 30%.
Yep.
But who knows? Maybe that doesn't happen for several years. I don't know. But at the end of the day, build a plan and figure out what your risk tolerance should be. But, I've always had those conversations. People are like, well, I just always been involved in the stock market. I don't know if I can tone it down. I'm like, well, I'm not here to tell you what to do. I'm just telling you what recommendations make your plan work at the end of the day.
Well, I also think, like, I don't know, for me, I just speak to myself and being a little bit younger and just my mindset is a little different. I think it's important to take risk into your own personal life as well, outside just every single financial decision, stock market, whatever it be. Like, one of the reasons why I am selling my house right now is because I'm tired of waking up, worrying about what's going to go wrong with the house, or if a tree's going to fall on my fence like it has before and I have to take the tree down, like all that other crap. So, like, that's a risk I don't want to deal with right now and I don't want to think about. So I'm going to go sell the house, go back to renting, and then that way I'm not being susceptible to that kind of risk in my life, so I can focus on other things in my life that I'm more productive at in some ways. So I just think throwing that out there as a mindset, I think it's important to think about that in a lot of your aspects of your life, not just financial decisions every time. I think it's important.
Absolutely.
Yeah. All right.
And I do remember the Browns did actually lose to the Jets with, what was that, a 3-touchdown lead? Wasn't that Joe Flacco on the other side too?
Yeah.
You remember that game? That was a wild game.
Remember that guy? How great he was for us at the end of last season?
Yeah, he's gone now.
Sitting on a couch somewhere again.
Almost football season though.
We're
almost there.
Did he get signed by anybody, or is he just going back to the couch?
No, he got signed.
Did he really?
Colts maybe.
Really?
Yeah, I want to say Colts.
Who's our backup? You have any idea?
Jameis Winston.
Oh, that's right.
Yeah.
Oh my God, the memes on that guy. Oh God. Anyway, I digress.
All right.
We shall see what happens. Who's Steelers quarterback now? Isn't it like Russell Wilson?
Russell Wilson, and there's another one. Justin Fields.
Oh yeah,
that's right.
Wow.
Mm-hmm.
Well, guess what? I know. It's pretty obvious what their offensive coordinator is going to do is just have some obviously quarterback option runs. Yeah. Like, holy cow! Can you imagine? Like, if they were, it'd be interesting if they flip flop quarterbacks every game. Like, you don't know who's coming out on the field. You know what that would do for a defense? Holy cow!
Yeah. Well, I don't think Justin Fields is going to see the field too much.
You don't
personally.
think so?
No, I don't think he. I don't think he's got it. But Russell Wilson does stink, so I guess we'll see.
Well, all right.
Well, we got some football in at the end of the planning corner. But yeah, make sure you're taking the appropriate amount of risk. I always tell people that when people come in to see me for the first time, the risk that they say they want to take and the risk that they're actually taking, I'd say it doesn't match 90% of the time. So just make sure you're aware of your situation and you're planning properly for it. But thanks for listening this week. If you guys have any questions, comments, or concerns, hit us up at info@swpconnect.com, and we'll talk to you next time.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.